Onto your markets news now. Asian stocks took a tumble following on from Wall Street's hard falls. A cautious outlook by the Fed around future interest rates could have been one of the reasons for the lackluster performance. Over in Japan, the central bank kept interest rates unchanged, although one Bank of Japan policymaker did vote for a hike, suggesting that a move to raise rates remains on track for next year. The Nikkei share average declined by 0.7%. The Hang Seng Index fell by 0.56%, while the Shanghai Composite Index ended the session down 0.36%. US markets plunged at yesterday's close, and that's with the much anticipated 25 basis point cut in interest rates. All the major indices were down by well over 2%, with the tech-heavy Nasdaq and worst performer falling over 3%. The Dow Jones Industrial Average fell by 0.8. The Dow Jones Industrial Average fell by 2.5%, and the S&P 500 fell 2.9%, while the Nasdaq Composite Index fell by over 3.5%. All right, just checking in on our local indicators. We see that the all-share index is currently trading in negative territory. It's down by 1.3%. On the currency front, we see that the local currency is much weaker relative to major currencies. It's trading at 18.24 against the US dollar, 19.01 vis-a-vis the euro, and 3.11 against the British pound. Gold is trading at $2,621 an ounce, while platinum is trading at $933 an ounce, and Brent crude oil is trading at $72.96 a barrel. Well, for more on the markets, I'm now going to talk to his portfolio manager at Sasfin Securities. Thanks very much for joining us, Muhammed. So, as anticipated, the US cut rates yesterday, but the response on the markets and other markets since is not exactly what one would have expected. Was it something about the Fed's remarks around its interest rate policy? What's your reading of the latest developments?
Thanks, Nompu. So, look, the cut came pretty much in line with expectations. I think everybody expected a 25 basis point cut to come through yesterday. What the market take issue with was the guidance for next year. So basically, the Fed's indicated that they're really only looking to cut twice, and that'll be 25 basis points each. And I think that's a bit of a dampener given sort of where expectations were. I think we were looking for really double that. Needless to say, you know, the markets really wanted more aggressive cutting. They probably wanted to have a view of lower interest rates toward the end of next year. Look, it will be lower, even based on this feedback. But I think we were looking for quite subsequent to that, I think it gave people that were looking to take profit a little bit of an excuse to, take that profit on the day, and we saw a bit of risk off sentiment pretty much pervading throughout America, and I would say the broader global market as well.
Yeah. So what does the latest Fed rate decision mean for South Africa's monetary policy and, in the shorter term, the local currency?
Well, I'll answer that second part of the question first. We've really seen quite a bit of volatility already. The rand is sitting at Rand 24, 25 on the currently, and it represents like a bit of a big move from where we were today and where we were sort of most of the week, which was under 18 Rand. In terms of how it's going to impact the Reserve Bank's monetary policy going forward, I don't think it'll have too much of a bearing. Ultimately, we've got to continue on our own path. Those rates need to come down to help tackle our sort of stagnant growth, and that is the SARB's sort of primary concern, unlike the Fed, who are sort of tasked with managing inflation as well. So from that perspective, I don't expect sort of too much of a downer on our side. We do have to have the rates come down, and I think that is still sort of foremost importance to the Reserve Bank.
Yeah. So, Muhammed, just give us your reflections on the performance of the local board 24, some of the stocks that have been winners for the year and those that have been losers.
It's quite an interesting one. If I cast my mind back to January 2024, I don't think I would have expected us to be, or the all share to be up 10%, this time of the year. You had mentioned this sort of earlier on in the show, but we were with load shedding, we had massively high interest rates, and we had an election on the horizon. I think everybody was quite nervous about. I think we had good outcomes in relation to sort of all of those things. The load shedding has eased quite substantially, the interest rates have started to come down, and we're seeing quite a bit of optimism just in relation the government of national unity. So I think considering all of that, we've done quite well to gain about 10%. We've seen some nice recoveries in the retail space. I think Mr. Price were probably the big surprise of the year in my mind. We saw some great performance from We Buy Cars following their unbundling from Transaction Capital. Capitec continued its run, gaining 50%. Pick n Pay also coming off low bases. And there were quite a few sort of other winners in the space. I think, on the other end, where we saw a bit of weakness was in our resource sector. Now, leaving aside gold, which performed massively well, pretty much all the other resources were under quite a bit of pressure. Sasol were probably one of the big losers on the year. Kumba iron ore not too far off. We also saw a lot of weakness in the platinum space, and commodities in general I think struggled. So hopefully we're bottoming out there and we can see some better performance in the next year. But all in all, I would say I was quite surprised, positively surprised by the performance we've got this year, and long may it continue, needless to say.
Indeed. So as we approach 2025, on the assumption that one is starting on a clean slate and has some cash to invest, how would you allocate the capital that you have, given all the risks that we know of, both local and international?
Okay, so assuming a clean slate, I think you've got to ask yourself, which themes are going to provide me with growth? Which companies, which themes are robust currently will remain the case within the next 5 to 10 years? And from that perspective, it's very difficult to look away from the US. When I think sort of the most pervasive theme of this year, of the year before, and probably of the next year going forward, is going to have to be the AI story. That's not closing over, so one has to get some exposure, and I would say some exposure to the big players there. So you're thinking your Microsofts, Googles, Facebook, Meta rather. Those are sort of well diversified within this space, strong balance sheets, and that's the type of exposure you want. I also quite like the cybersecurity space, and I think it's becoming even more and more prevalent with sort of the digitalization that we're seeing, which is a long-standing trend. But in addition to that, what I mentioned earlier, the AI also opens different avenues here. So that's So that's definitely something to look into. And then the last perspective is the weight loss drugs, which I think are quite attractive, especially at current levels. And then sort of looking onshore, like what I mentioned earlier, the resources have been under quite a bit of pressure. It does feel like we're at or very close to a bottom, and we are looking for catalysts. And when that does come, we want to sort of have exposure on the way up to benefit. I wouldn't want to be timing the bottom here. It's one of those things where I'd rather feel I'd actually feel a lot safer just catching it on the way back up. And then just the last thing to mention here, I think local banks are actually looking quite attractive as well. So you want to go for the quality ones, or sort of the star of the ASE, which is obviously Capitec. There's quite a few to pick from, and I don't think you can go wrong having some exposure to that space within your portfolio.
Yeah, and just very quickly on the issue of catalysts, at what point do you recognize when you've seen a catalyst? Because we've seen so many stimulus plans going into China, and one would think those will translate, but you can't time when those are going to translate into action, can you?
Yeah. No, so look, often enough, it is after the fact you'll sort of get some positive news. You mentioned the stimuluses and things like that. Out of China was obviously our big trading partner, and it does feel like it's almost sort of too late, but this is one of those things you've sort of got to be reactive. We're not going to see upside all overnight. I think things will have a little bit more clarity in terms of, the Chinese demand going forward. And there are big question marks currently. And I think once we get that clarity, it'll be a little bit more plausible, feasible rather, to jump in sort of on the bandwagon that is sort of the commodities.
All right, Muhammed, thank you so much for your time and insights. As always, Muhammed Wagley, he's a portfolio manager at Sasfin Securities. We're going to take a quick break.